Low risk bond investments are not acting low risk, and not again this year. So what are some alternative to bonds? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Bonds and stocks, typically, you're going to want to hold those together. That's part of a diversified overall portfolio, but they really behave very differently. Stocks, you're an owner. So yeah, you own, you're part owner in Apple, you're part owner in Google. And so you live with the risk, and with that risk comes, future potential returns. Bonds are differently. Bonds, you're a lender, and most people don't view it that way. That it's just an investment instrument. No, on that, you're a lender, and therefore, how it works is when you invest in a bond, and if you're buying a bond mutual fund or exchange traded fund, that mutual fund or exchange traded fund owns a bunch of individual bonds. But here's how it works. Say Coca-Cola, and say Amazon. Amazon's expanding and buying, building a new plant, and they need the money to do it. And so they borrow money, they issue bonds and say, we're going to need $300 million to build this new facility. So we're issuing bonds, $300 million, and whatever the interest rate is at that particular time. And well, how will they set the interest rate? Well, it's just based on what's the current interest rate environment. So they say, we need money, we need to borrow money, so who's willing to lend us some money? And they do that via bonds. So you invest, you lend them money, okay, and each bond is, let's just say, is issued at $100, and the going interest rate at the time, what they lock those in at is, let's say, 4% interest, and they're going to pay you off in 10 years. So a 10-year bond, you loan them money, and each of the bonds is worth $100. They're going to pay you 4% a year, and then they'll give you your $100 back after 10 years. So you give them 100. 4% a year for 10 years, and then you get your 100 back. That's how it works. And sorry if I'm repeating myself, but it can be a little confusing. Well, during those 10 years, you might want to sell that bond investment. It's traded. Those value will change based on people buying and selling it. Well, what will the value be? All right, if those bonds are at 4%, the interest rate, that's locked in for those 10 years. Say a year later, interest rates have fallen to 3%. Well, how attractive is your bond that's paying 4% if the going rate right now is 3%? Pretty good. So your bond investment, it will still mature at $100. But right now, if you wanted to sell it, it'd be worth more because the interest rate is above where current interest rates are. Take the opposite then. What if you've got that Amazon bond locked in at 4% and interest rates skyrocket to 7%? Now, how attractive is your 4% bond that you still have 9 years left to collect on? Not very attractive. And therefore, if you tried to sell it, or for people that are selling it, the value is less than $100. Even though you could just continue to hold the bond and it would eventually be worth $100 9 years later. If you wanted to sell it in the meantime, it's going to be worth less than that $100. Does that make sense? That's how bonds work. So the value of a bond before it matures, it's a teeter-totter based on what's happening with interest rates. If interest rates are going down like they did for 40 years, then bond investments are going up. They'll still eventually mature at $100, but they're going up in the meantime, before then. If interest rates themselves are going up, bond investments are going down. They'll still mature at 100, but the value is going down along the way. Because of inflation, and again, I'm not going to kind of repeat everything that happened, that the government printed $5 trillion and they said it wouldn't create inflation, so they're going to keep interest rates low. We started all seeing inflation pointing to, hey, it's costing more to live, and they said, no, it's not. No, we're keeping interest rates low. Okay, I guess I am telling you the whole thing because it's unbelievable. It's just unbelievable. They waited until inflation was around 9%, if you even believe that, before they started increasing interest rates, and therefore they had to increase interest rates rapidly. And as they increased interest rates rapidly, what happened with bond investments? Well, their value fell rapidly. We started seeing that in 2021, and in 2022, the bond market had its worst year on record. Okay, the bond index has only been around for about 50 years. It's the worst year in the bond market index. And if you go back further than that, at one point, I can't fact check this, but I saw at one point during the worst of it in 22 that bonds were having their worst year since the ratification of the Constitution. Things came back a little bit at the end, but still down 13%. And guys, as I'm recording it right now, take a look at this. The bond market has dipped negative again. The bond index has dipped negative again. And therefore, 3 years, if the year ended right now, that'd be 3 straight years of negative returns by the bond market, something that hasn't happened. And again, the bond index has only been around for 50 years, but looking at the overall bond market, that hasn't happened in 100 years. So the question is, should you continue to hold bonds? Well, yes, you should. They're a diversifier. There's less correlation, okay? I don't want to get, geek speak here, but they're going to move differently than the stock market. And when the stocks are going up, all you want is stocks. But when stocks are going down, you don't want any stocks, right? So it's going to give you that lack of correlation. It's going to give you lower correlation, so you should hold it. But when you look at the volatility recently, you might say, well, wait a second, I thought these were supposed to be lower risk, especially those of you approaching retirement and in retirement. It might just seem awful to look and say, gosh, last year my investments went down so much, and now this year I hear the stock market's coming back, but my investments haven't come back that much. Well, if you've got a large percentage in bonds, that's the reason. That's why if you're in retirement or at retirement, looking at that and implementing a personal pension plan so that the dollars that are fluctuating are the dollars that you won't need for 10 plus years, that's really the strategy that you need. But should you dump your bonds or get rid of them completely? Well, you've got to work with your certified financial planner. I can't give individual investment recommendations or advice, but when you look under the hood of the overall bond market or a lot of bond funds, I explained that they're issued at 100, they're going to mature at 100 unless the company goes bankrupt or whatever. And right now, most bonds, and I believe the aggregate bond index is trading right around $90. It will mature at 100 in 7 or 8 years from now, but right now it's valued at $90, and therefore there will be some future capital appreciation. Not to mention that, but even though bonds are more volatile recently, they are much less volatile than stocks. I've often said that a bad year in the bond market is a bad day in the stock market. They just move at different magnitudes. But considering the trajectory and considering that interest rates are on the rise again, and we're all looking at the Fed to see what are they going to do, what are some bond alternatives that you may want to consider working with your CFP? It's hard to argue against holding some dollars in just an overall money market account, okay? A savings account still isn't paying you anything. A money market account should be paying you somewhere close to 5% right now. And the money market account shouldn't have any fluctuation to it. So unlike bonds, where they do fluctuate up and down depending on what interest rates do, money market accounts are not designed to do that. I can't say they won't do that, but they're not designed to do that. The interest rate, though, will change. It's variable. Right now, it's around 5%. And so if you shift your bonds into a money market account and we have that appreciation from the bond market going from $90 a bond back up to 100, you'll miss out on that appreciation. But along the way, you'll be getting about a 5% interest rate on your money market. And if bonds remain volatile between now and that eventual appreciation, it'll be a much smoother and more stable ride in the money market account. So I would consider that is a strong alternative. Further beyond that, another alternative to bonds is instead of owning bond funds, I would consider owning an individual bond investment or a bond ladder, like I mentioned in yesterday's video with some retirees, where you're instead of holding a bond fund and not having some clarity on, well, when are these bonds maturing and what's their value right now, holding the individual bonds or a bond ladder or a fixed ladder, that can help you. Yes, there will still be some volatility, but if it's more on the shorter term, you'll have more peace of mind along the way because you'll know, nope, this is going to mature and it's going to mature at that original par value in 3 years, and along the way I've locked in a good interest rate. So money market account is one alternative to bonds. Second is building out your own individual bond ladder. Now, if you're interested in increasing the risk a little bit, a couple other alternatives to bonds that you could talk to your CFP about are hedged equity. Now, equity means it's going to be based on the stock market. So there's going to be a lot more volatility. Okay, so that's why I'm listing these last. So it's going to be a lot more volatility. But there's two types of hedged equity that tend to make some improvements on bonds or some enhancements to bonds. And one is a premium hedged equity where you're going to get some fluctuations because you're owning stocks, but you're also, the fund manager, ETF manager, is also writing stock options on that. So therefore the yield on it is going to be significant, somewhere around 10%. So how could you, if you're a high risk investor and you've held bonds just, because you wanted a little bit of income, well, should you complement some of those bonds with a hedged equity where you're getting a higher income yield, and yeah, you're getting volatility, but you're comfortable with it. So that's one option to consider. The other is, no, I'm not looking for yield, I'm just looking for better downside protection. I was expecting my bonds to do that for me, and they're not. Then I would consider hedged equity, but just hedged equity, one where there is some downside protections built in because some stock options have been used, and therefore it will fluctuate with the overall stock market, but there's some downside protections built in and some upside caps. Consider that, as well as some bond alternatives. Work with your certified financial planner. Again, they should be looking at all 6 areas of your financial life and would be in a great position to say, yeah, we do need to add a little bit of a different component into your overall investment strategy to keep you on course with your goals. Or they might say, no, actually, we need to make this significant change, or you're already set up appropriately with the right level of risk and for your financial goals. So work with your certified financial planner on that. If you do have questions about bonds, hopefully that helps you, give you a couple alternatives to talk to your CFP about. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.